My name's Lily Tran. I have a PhD in Econ and Finance from USC. My undergrad and my MBA is from UCLA. And I also have a degree in organizational behavior. I spent 12 years at Goldman Sachs as an economist, and then I also was a stockbroker. I left there in the late 2000s, and for the last several years I've had my own business. Came out of retirement. I was retired for 4 years. Came out of retirement, started my own business. My number one specialty is working with business owners of all kinds. The small business owner that has one employee themselves, all the way up to several hundred employees. And the number one complaint that I've had from clients, I've been in this business for the last 24 years, going on 25 years. So I've spent half of my life doing financial services. And the difference between me and most people is that my number one goal is to find a way to help you minimize your taxes and increase your assets. So you can make a lot of money, but if you can't keep it, protect it, and grow it, then you're really working for the IRS. And that's why people always tell me, I make a lot of money and I'm working really hard, but my money's not working hard for me. And that's what I specialize in. People like sitting down with Ryan, he owns multiple businesses. Well, my job, if I do it correctly, and I do this business 100% by referral, never spend any money advertising, because I believe if I take care of you, you'll introduce me to everybody else you know. So the last 24, 25 years has always been by referral, and I'm really proud about that. Everything that we talk about has no risk. At this point in my career, and like most of my clients, we're going into our 40s, 50s, and 60s. We don't want to risk our money. We want to grow our money, but we don't want to risk it. We've had a lot of people since 2008 have lost most or half of their money in the stock market, and 8 years later, they still haven't recovered. So that means that they've lost 8 years of their lives. And I know that you work really hard for your family. You're working, 18, 20 hours a day out at the docks, and you take a lot of risks. And my job is to help you find a way to keep that money you work so hard for and to take care of your family at the end of the day. If you can't work anymore, making sure that your money works hard for you. So without further ado, I'd like to talk with you, Ryan, about some questions that you and all your folks and friends might have.
My first question is, being a longshoreman, we have a 401k plan.
Yes.
And the way it's set up is that if we put in $1, they match it with $1. Okay. Anything over $1, it's still $1.
Right.
So I want you to talk to me a little bit about the 401k. And
okay.
Right now, I'm currently putting in $1 to get that $1.
Right.
The other money that would go into the 401k, I'm using that for my other businesses.
I agree with that 100%. You should never turn away free money. I always tell people, put in enough money to get the free matching, because even if the market doesn't do well, you still have that free money. Mm-hmm. So if that'll buffer any losses you have. But if you don't understand the market, or you're too busy, or it's just not your thing, you don't want to put all your eggs in one basket. It's important for you to have diversification. Just like I tell people, the best way to be a millionaire is to have different income streams. The best way to be a millionaire is also to diversify. Don't put all your money in real estate. Don't put all your money in the 401k. Don't put all your money in cash. Mm-hmm. You have to have a little bit of everything, because they're different asset classes. When the market goes down in real estate, at least you're still protected in commodities or different positions you have. I 100% agree that you should invest in your business, because you never know. You might get injured out at the docks, or you just might want, you want to do other things while you're working hard at the docks. Your money's working for you. Mm-hmm. So the best investment, of course, is in a business. And then also at the same time, you want to put your money in things that are protected. All the investments that we talk to you about, whether it's an annuity or a 7702 plan, that's the tax code that makes it tax-free for you when you take your money out. See, here's the benefit of what I recommended to you. One of the policies that I recommended is for you to have a 7702 plan. It covers many different things. Number one, if you were to close your eyes tomorrow, you were not around, your kids and whoever your businesses would be taken care of for life. Number two, it's a supplemental retirement plan. Your 401k is going to be taxed when you need the money the most. You can't touch it till you're 60 years old, 59 and a half, and at that time you have to pony up and pay taxes when you need the money the most. So my analogy is I'd rather you have a product where you don't pay taxes in the year you make it, and when you take it out you don't pay taxes. It's legally having your cake and eating it too. Because if you put it in all your money in a 401k and by the time it grows to say $1 million, I don't care what your political beliefs are, the government is broke, and by the time that we are ready to retire, there's not a possibility because we are so broke as a country that you'll be paying less in taxes. It's just not possible, whether you believe whatever you believe politically. It's just a fact. So what does that mean for you? Why not make sure that when you need the money and you start taking it, you don't pay taxes on the money? And that's why the plan that I put together for you addresses the year you make the money. You're able to deduct it because you own your own business. If you were just working at the docks as a W-2 employee, we could not set it up for you. The second thing is it's going to give you long-term care. If you ever get injured, you can't work, there's disability insurance, but when you're retired, you don't want to count on your kids and the government to take care of you. You don't want to be a burden. They might not want to or be able to financially. So the plan that I set up for you will give you $10,000 to $40,000 a month to take care of you for several years, whether you want to be taken care of in the nursing home, at home, or you want to just spend your years in another country. The company will send you a check and you're not taxed on that money. That's huge. There's no benefit that you currently have that offers you that. And also, it's a savings plan. Because the plans that we have a floor, you can never lose money, meaning that the market goes down 40%, 42% like it did in 2008, you would still be at 0 to 4%, so it can never go negative. It has that cushion set in. So what I tell people is, example would be, why would you just put money in the banks? They're giving you 0.1, 0.2%. Why are they doing that? Because they don't have money to give you money. People default on credit cards, car loans, home loans. Therefore, they don't have money to give you money. That's why you're giving such a low rate of return. Well, why don't you cut out the middleman and go directly to insurance companies and investment companies that insure the banks? They make up the FDIC. So by cutting them out, you'll average an 8 to 12% rate of return. The rule of 72 is a huge financial concept that everyone needs to learn. How many times do you divide an interest rate into 72 is how long it'll take your money to double? Example, if you were to get 1% from the banks, which you're not even getting now, 1 into 72 goes 72 times. That means every 72 years your money would double. You would be dead. Now let's say you got a conservative 8%. 8 goes into 72 9 times. That means that every 9 years, if you can get 8% on your money, it would double. 10 becomes 20, becomes 40. That's how the rich get richer, is because they find ways to minimize their taxes. Like Warren Buffett pays 12% less than someone that makes minimum wage, because they make rich decisions. They find people like me who spent their whole career understanding finances and the tax code. So if I were you, my advice is to find someone that understands how to help you work just as hard, your money to work just as hard for you as you work for it. And that's why this product was so life-changing, because it takes care of you if you're not here, your family, your businesses, whoever you love. It takes care of you if you get sick, you can't work. It takes care of you if your retirement plan is just your 401k and you don't have a tax-free retirement plan. It's a supersized Roth. And number 4, it takes care of you if you're saving money but it's not growing. Because I use the analogy is you're working hard, that's one oar that you're rowing in your canoe. The other oar, so that you stop going around in a circle, is to make sure that your money is efficient and it's growing and it's protected. That's why it's important to have a plan like this.
Okay. I have a bunch of friends down where I work, and I know a lot of them. Matter of fact, the one I was just met with right now paid $72,000 in taxes last year. He doesn't own a business. What could you say to those guys and women down, not just on the docks, but
anywhere. Everybody needs help.
What do they need to do?
Number 1 is you should always have a business, even if it is a business that doesn't make money. The IRS allows you to have a business for 3 years to lose money before they know that it's a shelter. So typically, if you open a business, you'll be surprised that since it's already open, you're actually going to do something with it. So I always tell people you need to have an LLC or an S Corp, because the $800-900 you pay in taxes to the state of California and have it is so much less than all the deductions you're missing out on. So someone who works out at the docks cannot deduct a portion of their home office at home. They cannot deduct a portion of their utilities. They cannot deduct their meals, their travel expenses, internet, cell phone. I mean, every single thing. When you travel, when you go on vacation, you're missing out on thousands and thousands of dollars by not having a business set up. It could be a consulting business. A lot of people, quite honestly, have what's called a shell company. They have these LLCs set aside so that they can write off things, and then they find, well, since I already have it, let me just do something else with it. But my number one thing is you should always have a company set up. It could be consulting, it could be sales. It doesn't have to box you into something. Number two, I would make sure that I sit down with someone like me and maximize all the deductions and savings, because typically a CPA and a tax person, their job is just to file your taxes. You want them to care and give you ideas. Well, you're looking at my tax returns, why didn't you advise me? They're not paid to do it, and they're not licensed to do it, nor do they have the experience nor the desire. So you're asking them to be everything that they're not. They just want to file your taxes. So that's why they didn't tell you to do an IRA or a SEP IRA or a Roth IRA or set up a 7702 plan or incorporate and start a business, because they're not financial advisors. They're tax filers.
Now, does everybody qualify for this program that you're about to set me up
No, 40% get declined because the IRS is smart, because this is a tax product where a tax-free product where you utilize the money in your later years. You don't pay taxes. Well, they need money. So they make it very difficult to qualify. There's a lot of different components. You have to be in good health. You have to not have felonies. You have to not have, more than one DUI. You have to have less than 3 speed. I mean, there's so many rigorous components involved, because this is where Congress puts most of their money. They understand the tax-free loophole. And if they made it easy, everyone would have it, and they would not make any money on taxes. So that's why 40% get declined. A small majority, which is 60%, do get approved. You are healthy, you have multiple businesses, there's a lot of extenuating circumstances for why they would want someone like you, but not everyone's going to be like that. They have, issues, it'll be hard. But my point is, it doesn't hurt to try, because this is giving you an ability to save money on the year you make it, and later on when you need it, you take it out. Why wouldn't you do something like this? And it doesn't force you to wait until you're 60. Let's say 5-7 years out, you need to buy a house or send your kid to college. This is a way for you to use that money and not go to the bank and get an equity line or maximize your credit cards, which have really high interest rates. This is your own self-funded annuity, and you're kind of your own bank.
So you're saying, let's take my friend, for instance, who spent $72,000 last year. Well, I mean, he gave it away, yes. So I'm saying spent.
Right.
If he were to do what you just said, start a business and got approved for this program, and let's say he put in $3,000 a month, which would be $36,000 a year. You're saying to me, later on down the road, he could take out that $36,000 without paying any taxes?
That is correct. That is correct.
Wow.
The only things you could do is the 7702 plan, which I set up for you, a Roth IRA, which typically you guys make too much for Roths, and municipal bonds. Those are the only 3 categories that are tax-free. 401ks, investment properties, IRAs, whatever you want to call them, they're all going to be taxable.
Okay.
So you're just delaying the day till you pay the piper.
Is there a time limit on that, to where if I'm putting in, let's say, $36,000 a year?
Yes.
Could I, let's say my son has to go to college the next year, can I turn around the very next year and take some of that out? Or how long does it take? Typically,
you want to wait about 4 to 5 years, so it has time to season and cook. Very good question.
Okay, you're saying typically you want to, but what's the legal parameters around
3 years.
3 years, okay. Okay, so after 3 years, you can start taking out.
If you need to, but I would wait, because that one gives you the most growth. Because think about it, it's double compounding interest. If you have a CD, checking, money market, just cash sitting around, you're paying taxes every year on that money. So they're giving you like not even 1%, then they tax you on it. That's ridiculous. Here, they don't tax you. You're earning interest on your interest. So that's where it's very attractive to people. So I tell them use that, but worst case scenario, yes. Use this money versus credit cards and other things that have such high interest rates.
Yeah. And one way of looking at it is that this is money you would have paid to the IRS anyways.
Yes.
So kind of pretend like it's not there.
That's correct.
So when you do hit 60 years old,
yes,
you can look back and say, whoa, what's this?
That's correct. And my opinion is I'd rather pay taxes on a little seed than this big fat apple tree, because your 401k is this big fat apple tree. When you start picking the fruit, you have to pay taxes. Your house is paid off, your kids are gone, you have no more deductions, and when you need to live on this money the most, then you pay taxes. So therefore, Social Security may not be around because it's been officially broke since 2009. So you're depending on all these things that may not be there for you. With the way we structure it, you have a very good idea of what you're going to get, and it won't be taxed. That's 30 to 50% savings right there on your money.
Okay.
So that's why I always tell people you need to have diversification. Yes, have your 401k, but have your own self-funded, supersized Roth 401k, life insurance, everything all in one.
Yes, because it would be crazy not to put that dollar in to get that free dollar from the company.
That is correct.
For the 401k.
But then I'm not asking you to spend money you don't have. I'm telling you to take it from your left pocket to your right pocket versus out the door to the IRS. To me, this is a no-brainer. You don't. It's such a logical decision. Why am I going to give $72,000 away? Why not put it somewhere? It's still going to go somewhere, but it's still my money. Most people think I don't have options, so I'm just going to blindly write a check, but they never sat down with anybody. So that's why people like me are very important, because we come in and we say, wait a second. You work your butt off. Why are you giving your money away? Let me help you keep it. So don't look at it as an expense. Look at it as I'm moving my money in the most efficient manner possible.
Sure. Now, to figure out how much you would want to put in there, wouldn't you have to figure out what you're bringing home, what your current overhead is, and whatever is extra in there?
Well, what we do is we sit down and we look at their paycheck. How much are they paying out in taxes? We look at the last couple of years in taxes. We look at where they're invested. We look at when they're going to retire, how old they are. There's a lot of different things that are part of the equation to figure out what is the best possible plans for them. There's a couple things I would look at in terms of where to help them invest their money. Number one, wherever I put it, it's 100% publicly traded companies that have been around for at least 100 years. Number two, they all have a 0% minimum floor, meaning they can never go negative. Unlike the 401k that has ups and downs. You can't lock it when it goes up, and you can't stop the bleeding when it goes down. With what we do, it's more moderate, but for the people who are busy and don't have time, at least you know your money will grow. Versus up and down with the market, and when you dollar cost average, you're negative, because once you subtract the fees of 401ks, there's 17 different fees. You really didn't come out ahead that much, 7%, but then you paid 3 to 4 until your rate of return is really 3 or 4 versus 7. So you got to look at those things too. Plus you pay taxes. So it's not the most efficient, but because you get free money, that's the only reason why. If you didn't get company matching, I would tell you to do something totally different.
Okay. So what's the next step? Where do we go from here?
The next step is for anybody that wants a consultation, get their information. Jennifer is the one who helps manage, because we work with so many people out in San Pedro. We're very blessed that we work with a lot of the longshoremen and women of San Pedro. Jennifer helps me manage my schedule, and she helps qualify them before I sit down with them, because we want it to be efficient. And you know, we have thousands of clients, and so we want to give everybody the respect and time that they deserve. So they would get with you and Jennifer, who's my right-hand person, to coordinate what they need to bring to a sit-down with me, a complimentary sit-down, to see if we're even a fit for each other. And then we'll go over all the different things and my suggestions of how they can save money. And so it's a complimentary thing, because you guys are with the union. We don't charge that $5,000 fee.
That's what my next question was. So you're not making money on this? You're not going to charge me?
No, typically it's $5,000 to sit down, because there's so much value in what I do. But because it's a contract with the longshoremen to provide a service to you guys, even if they never did any business, consider it that they got, you know, a free hour with someone who specializes in spending all these. My whole career has always been in this world. So I don't know anything different. And I always tell people, if you're sick and you're not feeling well, you should find the best doctor to help heal you. Well, if you're not sure about your money, you should find someone that spends their whole career and has all the degrees and experience and is there working to help you become more efficient and help protect your family and grow your assets.
Yeah, you wouldn't want somebody else putting a container on your chassis.
Yeah, exactly.
Yeah, that's a good analogy. So,
and even if they have someone, when it comes to your money, isn't it important to get a second opinion?
Sure.
You don't want to get to retirement and find out you're not set. I always believe get a second opinion whatever you do.
Sure.
Because they might have their friends or family, or they might be Googling it. Why not find someone and that way you know you're in the right vehicle.
Yeah. Okay.
Right? So my analogy is if you were to drive from here to New York, wouldn't it make sense for you to have a map so you can get to your destination versus driving around aimlessly?
Yes.
If you don't know what it's like to be financially free or what retirement looks like, wouldn't it make sense to have a financial roadmap to make sure you get to your destination and that you're in the right vehicle to get there on time or even at all? Yeah. Why would you go through life aimlessly hoping to get there?
Yeah, makes sense.
Yeah.
Okay, well, thanks for your time, and I think this is going to help out a lot of people that are driving around aimlessly right now. Thanks a lot, Lily. Appreciate
no problem.
it.
Thank you.
All right, take care.